Good afternoon and welcome to another Wealth of Advice market update on the 9th of May 2022. We bring this latest update to you after several weeks of further market turbulence, which has been brought about as a result of the ongoing war and situation in Ukraine. However, the main reason, if you like, is high inflation and what world governments are going to do to solve inflation. You've seen the UK raise interest rates back to 1%. The US have raised their rates. There was a fear in the US last week that there's going to be further tightening by the Federal Reserve in America. That caused markets to fall towards the end of the week. So we're seeing all of these negative things at play, which is causing markets to fall in recent weeks. So hopefully the next few slides that we're going to go through will reassure you, as ever, that we are invested clients in the right areas. We are confident of the long-term growth in the future, 1, 2, 3, 5 years down the line, albeit that the next few weeks and months might be a little bit choppy and maybe negative. But personally, I'm still confident that as we see earnings come through from companies in the second half of this year, you will see some good numbers posted. There is a fear that world is going to go into recession. The UK is gearing itself up that we might enter a recession in the next few months, but we'll have to wait and see how that unfolds. So hopefully, as I say, these slides will reassure you. So we'll start with interest rates. The chart that you can see in front of you right now shows what's happened with UK interest rates going back to 2012. As you can see, interest rates hovered along at 0.5% up until 2016. 2016, we obviously had the Brexit vote. The pound absolutely collapsed. There was a fear that the UK economy was going to be so weak. So to stimulate growth, the Bank of England reduced interest rates down to the level that you can see on there, which is 0.25%. A central bank will always want to raise interest rates because it is a tool that it has at its disposal, a lever sometimes it's called. When it needs to supercharge the economy, it can reduce interest rates. When it needs to slow down the economy or perhaps put a dampener on inflation, it will try and raise interest rates. So as you can see, from 2017 up to 2020, the Bank of England embarked on a strategy to try and raise interest rates again, and we got back up to 0.75%. Then COVID comes along, just like the COVID stock market crash graph that we've shown. Interest rates went all the way down and we got them back down to 0.1%, lowest rate in history. I don't know if you remember, we did an update video where we were talking about what negative interest rates may have meant for people, and it certainly looked like that was the way we were going. But then, as you can see, in the last few weeks, last few months, after we've come out of obviously the COVID crisis, as it were, and the war in Ukraine and Russia has ratcheted up, and then you've seen such a massive increase in the price of oil, energy all over the world, as well as other goods and commodities. The Bank of England have raised interest rates, and we're now up to 1%. So right now, this is going to hurt the economy in so much as it's going to dampen spending, which is what the government wants, to try and keep a cap on inflation. It's obviously not good for yourselves when you look at what your investment and pension valuations are, but in the long term, it's good for a country if it can get its interest rates back up to a good level. Years ago, when interest rates were 10, 12, 15%, people may have thought that was a norm. Even when interest rates were around 5, 6% in 2005, 2006 kind of period, before we had the economic crash in 2008 when interest rates were brought down to 0.5%, people would have imagined or assumed that interest rates over the long term should be at a high level. But I think if you look back at 300 years of history of interest rates, a rate of around 3 to 3.5% is probably the long-term average that a central bank will want to get to. So at 1%, it's still very, very low from an interest rate point of view. But this is one of the causation effects of why markets are a little bit wobbly at the moment. The reality of the matter is them raising interest rates right now is not going to have much effect on you, the end consumer, right now at the moment. It's how it then plays out across the economic cycle that will affect markets going forward. And just to continue on with interest rates, when we look across to the US, obviously such a major player in world economics, investment markets and such like, their interest rates also jumped to 1%, which was their biggest jump in 22 years. But their Federal Reserve chairman said the US economy believes that it's performing really well and is strong enough to withstand these rate increases. So again, it just emphasises the point that the economies, as we've come out of COVID, have performed well. People have been back out spending, and as a result of people being back out spending, inflation has crept back into the economy. It was always going to be something that happened. Clearly, what's gone on in Russia and Ukraine hasn't helped things. because of the energy price going up, the price of oil going up. But when you then look at what BP have announced, their profits have more than doubled in Q1 of 2022, reporting, I think it's $6.2 billion worth of profits compared to 2.6 billion in Q1 2021. So that will be benefiting some parts of your investment portfolio that do invest in oil companies. There's been a call for windfall tax on energy companies. Whether that happens is another matter. I don't think it's going to affect things in the markets in the short term, so it's just noise that's out there. But as I say, with regards to inflation and prices going up, there are always going to be companies who benefit from this, and over the long run you should see those filter through into better returns in your portfolios. So we've mentioned that some analysts are saying that a recession may be around the corner. However, we've got to keep repeating the fact that we're not living in times which feel like a recession is due. When recessions have happened in the past, you've always coupled them with high unemployment rates. The graph that we're showing on the screen now shows what the US unemployment rate has looked like over the last few years. And as you can see, whilst it spiked when COVID happened, it has come back down, and we're now back to what are historically low levels of unemployment. That has to be good for an economy. Most businesses are reporting that the biggest problem they've got is actually finding good skilled staff to employ in jobs to overcome supply chain issues. And I think supply chain issues, i.e. not being able to get enough goods to the market on time, so to speak, is possibly why prices of lots of items are going up. So as soon as we can get the required people into these jobs, and as the unemployment rate continues to come down, again, that can only be a positive for the economy. So yes, whilst inflation is really high at the moment and there are some negative things that's going on out in the world, the fact that the unemployment rate, not just in the US but all over the world, is at really, really low rates, can only be seen as a positive. In the last update, we showed you several stock examples of how companies just who aren't performing very well in 2022, how their share price has gone. We mentioned Netflix. That's the first chart we can put on there. You can see nothing's improved for them. Their share price is down almost 70% year to date. Disney, Walt Disney Corporation, which is massive, their share price is down almost 30% on the year. I can't figure that one out, as I say, because it's a company that's got such high levels of cash going into it. But obviously, like the Netflix story, where it's linked to people's streaming services and people are cancelling these streaming services, inflation's coming really high and people are looking what can they get rid of, then obviously Disney's affected by that. Facebook, whilst their share price did jump a little bit in the last week or so, it's still down almost 40% year to date. So these stocks will be in certain client funds that we might invest into, and the fund managers who invest into these probably wouldn't have saw, for instance, that the Facebook fall, as you see there, where it dropped by 30% virtually overnight. But you're not necessarily going to sell these companies because they're still good companies to have. Shopify, obviously online retail sales and such like, is down compared to where it was during the pandemic when people were just buying everything online. Their share price down almost 70% year to date. So there's some really horrific stories out there, individual stocks. And again, this is why we don't ever recommend clients invest in individual stocks. We invest in funds where a fund manager will be picking funds and picking stocks and selling stocks when they don't need them or they don't want them or they don't think there's value to be had. But again, going back to the oil companies, BP, their share price is up only almost 22%, 21.85% year to date. Shell share price is up 36.7% year to date. Apple, their share price is up 24% over the last 12 months as people will continue to buy Apple products. But even with this Apple graph that you can see in front of you there's been lots of volatility along the way. There will be people who bought into this stock in January who saw the price fall, who bought into it in February and saw the price fall. Only if you'd held this stock for a full 12 months have you made that 24% growth. And again, just brings back, hold these things for the long time and you will get the growth coming back through. But as I say, with regards where our client portfolios are invested right now, overall, we are happy with how all the fund managers are doing. Yes, we're disappointed with the recent performance and the recent volatility, but there's not much that these fund managers can do when a lot of that's caused by super inflation coming along on the back of a war, on the back of sort of an energy crisis that we haven't seen for a good number of years. So as I say, we're not recommending any changes to our portfolios right now. Over the past couple of years when we've been doing these client update videos, we've shown you what's going on in the volatility index. The VIX index, again, we've put this graph going back to May 2007 there, when you can see as we got into the financial crisis, it shot all the way up to well over 700. We never saw anything on that scale again until we got to COVID in 2020, when it went above 800%. From there, as you can see, it went down nicely all the way back down, but obviously in recent weeks, with what's been going on in the world, you can see that it's ticked back up, and the volatility index is at a higher point now than where it's been for a little while. But as you can see how quickly things can move, although it's going up, it can move back down in not too long of a time. Obviously, during times of volatility in markets, and when markets are underperforming and going down in value, you will obviously hear your people say, well, I wish I just left my money in cash. I would have been better putting my money in cash because I wouldn't have had any risk. High inflation is obviously a massive enemy to cash, because if you're not getting much in the way of interest rates at the bank, and even though the Bank of England have raised interest rates, you haven't immediately seen banks rush out to say we're going to suddenly give you loads more on your cash deposit rates. If you look at the graph that we've put on the screen there now, going back to May 2012, if you'd left money sitting in a cash account, earning effectively nothing over the last 10 years, and the rate of inflation that's come along, your real return on cash over that 10-year period is minus 14%. So again, it just hammers home the point that over the long run, you cannot leave your savings and investment, especially when it's for a desired objective like retiring in the future, or for some other event way down the line. You just can't leave your money in cash. Obviously, if you are planning on spending money in the next 6-12 months and volatility was really high, then yes, put it into cash because you've got a specific need for it in the short term. But if you are long-term investing, you don't leave your money in cash because inflation will kill it. So we now come to that part of the update where we look at how various stock markets have done so far. The first graph you can see on the screen there is how market indices have done year to date. And as you can see, the FTSE 100, loaded up there with BP and Shell, as we know, is the most positive performing index. The MSCI World Index is down almost 6%, and it's the S&P 500 that's down almost 5%. Given that the FTSE 100, as I say, is dominated by oil stocks, you would expect this to continue while that oil price remains high. In the last week or so, with the talk that the EU are going to ban taking any oil from Russia by the end of the year, that saw a spike in the oil price, and it may be that if that goes through, that the oil price will remain high, and that will be obviously a negative thing from an inflation point of view. And that's where you'll see the better returns come in the UK market. But right now, things are changing so rapidly. The news stories that are coming out, you can't really make an investment decision overnight to say we'll change from this to that, because the news stories are coming out quite thick and fast. We're taking a longer term view. We still firmly believe that having a good amount of your portfolio allocated across these areas will prove to be successful in the medium to long term. We now put in how the stock markets have looked over 12 months, and the position flips. The MSCI World Index is the worst performing index, FTSE 100 is the one in the middle, and the US still outperforms with 11.45% over 12 months. That goes back to the end of May 2021. But you can see there how markets came right the way down from November all the way down to March. Came back up nicely as we got into April, and then loads more volatility again in recent weeks. And then the third chart that we're putting on there now just again looks at the model portfolios that we run, how they've performed over 5 years. Both the Wealth of Advice portfolios and the Royal London portfolios, you can see there, they're all positive over 5 years. You would obviously expect that, and you still see the higher level of risk that you take, i.e. more exposure to the stock market, has performed better over that 5-year period, and we would obviously expect that to continue. But what you're seeing now, as I say, in the last few weeks and months is much more volatility, obviously to the level that we saw around, not quite to the level that we saw 2020 when COVID happened, but certainly more than we've seen probably over the last 5 years. So for those clients who've been invested over the last 5 years, you've gone through loads really. You've had the EU vote for the UK to leave the EU, Brexit. That was just the main news story for so long. Donald Trump in the White House causing his trade wars with China. Then COVID, everything recovered after that. And then we've had quite a bit of volatility in the recent weeks. So overall, as we keep saying, be invested for the long time and you should be rewarded. And as I said earlier in the presentation, if any clients have any major concerns or want to get in touch, please don't hesitate to give us a call or drop us an email. Thanks again for listening to another Wealth of Advice market update, and be rest assured we'll be back in touch in a few weeks' time when we have another presentation ready to go.